how we can now be able. So the diagram on the Baumol cash management model, I will draw the diagram on the board, then we show how it looks like. So you can write that diagram in your notes. So the diagram is supposed to look like this. That diagram is supposed to appear. So this area will be the time, and this one will be the cash balances. Cash balance. So this part will be the lower limit. Lower limit. We use L to represent the lower cash limit. Then we shall also be able to have the return point. This is the return point. Return point or the target. Target or optimum. Or optimum. So this one we use Z to represent it. So that one, so it is the return point or the target or optimum. So we use Z to refer to that. Then this one will be the upper limit. This one should be the upper limit. So upper limit we use H. Then the upper limit. So upper limit we use H to represent it. Then also know that have it also expressed like that. So this region, we refer to it as H minus Z. H minus Z. Then this one is meant to be Z minus L. So that should be how it should be summarized. So that was meant to be the diagram. Then when you check still on the same, they continued to say that Miller and Oro cash management is used to make decisions as follows. So it is meant to make the decisions as follows, where they were able to say that when the cash balances increases up to the upper limit H, then the company should invest shillings H minus Z in the short-term marketable securities. Then B is that when the cash balances reduce up to the lower limit L, then the company should convert shillings Z minus L to from the short-term marketable security into cash. Then if the cash balances are along the optimum limit, i.e. at Z, then no action should be taken. So I want to use the question from your past papers to discuss that item. So the first question I want us to check, May 2018, question number 1, part C. We can go through the question for May 2018. May 2018, there is a question number 1, part C. May 2018, there is a question number 1, part C. So May 2018, question number 1, part C. May 2018, there is a question number 1, part C. So that question 1, part C for May 2018, the question reads that Mandani Enterprise maintains a minimum cash balance of 10,000 shillings. The standard deviation of the daily cash flows is 2,500. So the transaction cost of each marketable security issuance 20. So the interest rate of the marketable security is 9.2%. The interest rate of the marketable security is 9.2% per annum. Assume there are 365 days in a year. Assume there are 365 days in a year. So required using Miller-Oro model of the cash management. Determine Roman letter 1, optimal cash balance. Roman letter 2, upper cash limit. Roman letter 3, the average cash balance. Roman letter 4, the spread. So we start with the Roman letter 1, the optimum or the return. So this is Z. We should be calculating Z. So to compute the optimum, when you want to calculate the optimum, so to get the optimum or the return point, we use Z. We use Z to refer to the optimum or the return point. So it will be given by 3B. So I will explain what each one of them stands for. I will be able to explain what each one of them stands for like that. Then we add L like that. So when you want to get the optimal cash balance, that should be equal to 3B. Then that, so divide by 4I, so the all of which is raised to the power of 1/3. Then we add L. So where this particular B, this B is the transaction cost per transaction. So that particular B is the transaction cost per transaction. The transaction cost per transaction. Then this other one here, this one is the variance of the daily cash flows. So this particular one is the variance of the daily cash flows. The variance of the daily cash flows. Then there is this particular I, this one here. This is the daily interest rate. It's the daily interest rate on the marketable securities. Daily interest rate on marketable securities. Daily interest rate on the marketable securities. Then L is the minimum cash balance. L is meant to be the minimum cash balance. So we can now answer that Roman letter 1. So it is 3. So B is the transaction cost. When you check through the question, they were able to give you about the transaction cost of each marketable security is 20. So our P is 20. So the question had given you the standard deviation of 2,500, but we require the variance. So to get the variance, we square that particular standard deviation. So you take the 2,500, then you square it. Then we divide by 4 multiplied by I. I is the daily interest rate. The question gave you interest rate per annum of 9.2%. But down there, they have said that we assume there are how many days in a year? 365. So 9.2% is the same as 0.092. So that figure divided by 365 days, because we require the daily interest rate. I is daily interest rate, but what they gave you is per annum. Then after that, the entire of this part raised to the power of 1/3. Then we add the lower cash limit. Lower cash limit, you are given the minimum cash balance as 10,000. You are given as 10,000. So get that figure. Come up with that portion. So you calculate, then you give me the figure, compute, and give me that value. So compute, then you give me the figure. So once you calculate, you let me know the figure you are coming up with. Once you have computed, give me the figure. $3.719, it is a very small figure. The minimum is 10, so it should be more than 10,000. The minimum cash balance is 10. So whatever you compute, it should be more than 10. Anyone who has calculated? So I've seen 17,191.6. That should be the correct figure. It should be 17. When you round off, it should be 17,192. So if anyone has a problem, you let me know to see how to assist. So is everyone okay with that answer? Sorry? 1.2. So those who are online, are you comfortable with the answer you have calculated? So let us start together. Those who are not getting it, can you pay attention so that we work it together? So I will advise you, you start with this figure. So can you have 2,500? Then you square it. So you have gotten the figure. Yeah, so multiply by 20, multiply again by 3. So get the answer. So you have gotten that answer. So after getting that answer, divide, because there is a division sign like that. Once you have divided, I would like you to open the brackets. Once you have divided, you open the brackets. You can see the brackets on your calculator. Then start again with this one here, 0.092 divided by 365. Then multiply by 4. Then close the brackets. Multiply 4, then you close the brackets. So you have closed the brackets. So once you have closed the bracket, you will press the equal sign. So once you have pressed the equal sign on your calculator, there is this particular sign. Press that sign on your calculator. You have that sign. Then once you have pressed it, also again open the brackets. 1 divided by 3. You close the brackets. Then get the answer again. So the answer you get, now you can add the 10,000 and see the figure you are getting from there. So you get which value? 17,192. We round it off to 17,192. So everyone is okay up to that point. Those who are saying no, are you now getting that figure? Yeah, so that should be how you compute it. So you follow that format and get the value. So that's now our Roman letter 1. How you are to calculate the optimal cash balance. So we go to the Roman letter 2. We got the Roman letter 2, where now we calculate the upper cash limit. Roman letter 2, you want to see how to calculate the upper cash limit. So we go to the Roman letter 2, how to compute the upper cash limit. So upper cash limit will be H. Upper cash limit should be H. So H is supposed to be given by 3Z, like that. We minus 2L. So when you want to get the upper cash limit, you simply take 3Z, we minus 2L. So it will be 3 multiplied. So Z is what we have just calculated. Z is what we have just calculated. It was 17,192. 17,192. Then you minus 2. L is the minimum cash balance, which is 8,000. L is the minimum cash balance, which is 8,000. So it is giving us which figure? Sorry? Sorry, not the 8, but 10. The minimum cash balance. The minimum cash balance is 10, not 8. Sorry. Minimum cash balance is 10,000, not 8. So what are we coming up with? Yeah, so now we go to the Roman letter 3, average cash balance. Let us also see how to get the average cash balance. So to calculate the average cash balance, now to get the average cash balance. So to compute the average cash balance. So average cash balance is supposed to be given by 4Z. 4Z minus L. Then you will be required to divide by 3. Like that. So when you are using Miller-Oro cash management model, if you want to calculate the average cash balance, it is simply 4Z minus L, we divide by 3. So it will be 4. So Z, you already have it. It was 17,192. 17,192. You minus L. So L, we know it is 10,000. Then you divide by 3. So that is now our average cash balance. That's being the average cash balance. So it is giving us around which figure? 576, 589.3. Okay, so that now is our average cash balance. So now you go to the Roman letter 4, the spread. We go to the Roman letter 4, where they also want you to get the spread. So the spread is supposed to be given by the spread. So spread will be equal to the spread will be equal to H minus L. So you simply take the upper limit, we subtract the lower limit. So the spread, we simply take the upper limit minus the lower limit. Upper limit was 31, 576. So subtract 10. So that is what will now give you the spread. So that is now for that particular question. So I want us to get one more question on the same. This one, I want you to check November 2020, question 3, part A. November 2020, question number 3, part A. I want you to check November 2020, question number 3, part A. November 2020, question number 3, part A. So you go to November 2020, question number 3, part A. November 2020, question number 3, part A. So that question 3, part A for November 2020, they were giving us details that the following information relates to power traders. Number 1, minimum cash balance is given as 8,000. That's now our L. Not number 2. The variance of the daily cash flows is 4 million. The variance of the daily cash flows is 4 million. Then equivalent to the standard deviation of 2,000. So if you are given the standard deviation, you square to get the variance. But if you are given the variance, you just use it directly the way it is. They continued to say that, not number 3, the transaction cost for buying or selling securities is 50 shillings. The note number 4, interest rate is 0.025% per day. So required using Miller-Oro model of managing cash. They wanted you to determine the following. Roman letter 1, the spread. Roman letter 2, the upper cash limit. Roman letter 3, the return point. Roman letter 4, propose a decision rule for the cash management to the company based on your answer, your calculation in A, Roman letter 1 to Roman letter 3 above. So in that question, we cannot start with the Roman letter 1. Roman letter 1 is what you have seen as the last one. So you start with the Roman letter 3. On that question, you must start with the Roman letter 3, the return point or the optimum point. Then you go to the Roman letter 2 before you go to the Roman letter 1. We cannot answer Roman letter 1 unless we have Roman letter 3 first, then Roman letter 2. And now in the process, we come up with the value for that. So we can start off with Roman letter 3, the return point or the target point. The return point or simply the target point. So we start off with the Roman letter 3. So that Roman letter 3 is Z. Return point the same as Z, or optimum or the target. So we start by calculating Z. So Z is supposed to be given by, Z is supposed to be given by, so 3B variance, we divide by 4i, then 1/3, then we add L like that. We add L like that. So it will be 3. So B is what you have been given in the note number 3. The transaction cost for buying or selling the securities is 50. So multiplied by 50. So this question has given you somewhere, you see the variance of 4 million. So variance is 4 million. So you just use it the way it is. Or alternatively, you take the 2,000 and square. You see, they have also given you 2,000 the standard deviation. So, but now they have also given the value. So we use it directly like that. Then we divide by 4 multiplied by. So this time they gave you daily interest rate. The other one they gave you per annum. That's why we divided by 365. So this one you take it the way it is. So can you take that figure 0.025 divided by 100 because it is a percentage. When you take 0.025 divided by 100, it will be the same as 0.1. Should be 0 point. There are how many zeros after the decimal point? 3. Like that. Online, can you see that item? They gave you as 0.025%. So divide by 100. So that we get, so it is daily interest rate. So the question had already given you the daily interest rate. Then now from there, come up with 1/3. Then we add L is the minimum cash balance. So that minimum cash balance in the note number 1, they gave you 8,000. They were able to give you 8,000. So can you try and see what value do we come up with on that figure? You get 16 points. 16,434. Yeah, even online, they are giving me 16,434. So they are getting 16,434. So that should be our Roman letter 1. So which is Roman letter 3. So we go now to Roman letter 2, which is meant to be the upper cash limit. We now go to the Roman letter 2, which is meant to be the upper cash limit. So to get the upper cash limit, you remember the formula for the upper cash limit is H. So H should be equal to 3Z minus 2L. It is 3Z minus 2L. Is 3Z minus 2L. So it will be equal to 3 multiplied by Z. So Z, you have just calculated. You said it is which figure? 16,000. So 16,434. Then you minus 2L. So L was the minimum balance, which was 8,000. So after that is now when you can go to the Roman letter 1 to get the spread. So after that, now you go to the Roman letter 1, you compute the spread. So spread is H minus L. The spread should be H minus L. So what is that figure for H? 33? 302. So now you subtract 8 like that. Then you subtract 8 like that. So that is now your Roman letter 1. So there is no way you could answer that Roman letter 1. You have to start with the return point or the target. Then you go to Roman letter 2 before you. So I also want us to calculate the average. The question did not ask, but from the other question, I've shown you how to get the average cash balance. So let us also compute what is supposed to be the average cash balance. Let us also see how we can come up with the average cash balance. The average cash balance. Let us also see how to get the average cash balance. So to get the average cash balance, it is supposed to be given by, so it is 4Z minus L divided by 3. So that should be 4 multiplied by what? 16, 434. Then you minus 8,000, then divide by 3. So we shall have a short break for the prayers. Then we come back immediately after 5 minutes so that we finish the question and do something different. So you can stop there for now.
Sema atakuwa amefika alafu akatoka kaeti. Sio ni
So we now make the decision in the Roman letter 4. So Roman letter 4, the question wanted you to make a proposal, a decision rule for cash management to the company. The cash management to the company. So let us now make that decision. So when you are making the decision, there are 3 key items you need to come up with. There are 3 key items we should be able to come up with. When we make the decision, there are 3 key items we should be able to come up with. So the 3 items that we need to come up with, the first one should be H. Identify H. We identify H. H was how much for this question? 33,302. Then you remember Z. Z was how much? 16,434. Then we know L. L was given us 8,000. So I want us to go to your handout. So to make the decisions as per the information you have on your handout. So when you go through the handout, they have said that Miller and Oro cash management is used to make decisions as follows. So we start with A. I want us to write that decision A. So let us write that decision A, that when cash balances increases up to the upper limit, when cash balances increases up to the upper limit, in brackets H, then the company should invest. Shillings H minus Z. The company should invest shillings H minus Z. So we know H, it is that 3,302. We minus Z, which is 16,434. So how much is that? Get the difference for that. 868. So we write that, then we finish by on the same note as in the short term marketable securities. So that's now the first decision. Any moment cash will go up to the upper limit, simply take the upper limit minus the return point should be converted from cash to the marketable securities. Now we go to B, the decision B. So B, they have said that, we write that when the cash balances reduces up to the lower limit, when the cash balances reduces up to the lower limit L, then the company should convert shillings. Z minus L should convert shillings Z minus L. So we have them. Z is 16,434 minus 8,000. So it should convert to Z minus L. So this should be 8,434. Yeah, so 8,434 from short-term marketable securities. From the short-term marketable securities into cash. From the short-term marketable securities into cash. From the short-term marketable securities into cash. Then finally, there is that now decision C. Decision C, we also comment that if the cash balances are along the optimum limit, if the cash balances are along the optimum limit, if the cash balances are along the optimum limit, if they are along the optimum limit, i.e. at Z, then no action should be taken. 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 So that is now Miller and Oro cash management model, how you can be able to use it now to make the decision in relation to that. So still on that issue of the cash management, there is something else. I also want us to write something brief on it. So let us write there another paragraph, and we can have something brief about the methods of financial forecasting. Methods of financial forecasting. So we had already done something on it, but now I'm doing it because we are now on the cash management. How do we get there for the cash? So we look at the methods of financial forecasting. So number one will be percentage of sales method. So number one will be the percentage of the sales method. Then number two will be the cash budget. Number two will now be the cash budget. So we can start with percentage of the sales method. We can start off with the percentage of the sales method. So when it comes to the percentage of the sales method, we can summarize that under this method, the following steps will be adopted. So step number one, we can have step number one. Number one is that identify the balance sheet items. Which will change when the sales change. Identify the balance sheet items which will change when the sales change. You identify the balance sheet items which will change when the sales change. And still on the same, you know that they include fixed assets. They include the fixed assets, current assets, current liabilities, and the retained earnings. Then you continue on the same by noting that NB, you can have it as NB or are not. So NB or are not, you write that long-term debts and ordinary share capital. Long-term debts and the ordinary share capital. Long-term debts and the ordinary share capital will not change with the sales. Since this capital is required to finance long-term projects. Since this capital is required to finance the long-term projects. It is required to finance the long-term projects and not for the revenue expenditure. 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 Then number 2 is that step number 2 is that express the various balance sheet items. Express the various balance sheet items. Express the various balance sheet items which will change with the sales. Express the various balance sheet items which will change with the sales, which will change with the sales as a percentage of sales, which will change with the sales as a percentage of the sales, as a percentage of the sales. Then finally, the step number 3. The step number 3 is that determine the total financial requirements. Determine the total financial requirements. Determine the total financial requirements during the forecasting period. Determine the total financial requirements during the forecasting period. During the forecasting period, due to increase in the sales. During the forecasting period, due to the increase in the sales. Due to the increase in sales. Then finally, the step number 4 is that compute the external financial requirement of the company. Compute the external financial requirements of the company. Compute the external financial requirements of the company during the financial period as follows. Compute external financial requirements of the company during the financial period as follows. During the financial period as follows. So to get the external financial requirements, to calculate external financial requirements. External financial requirements. Get the external financial requirements. We start with increase in the fixed assets. Increase in the fixed assets. Increase in the fixed assets. Then add increase in the current. Increase in the current assets. Increase in the current assets. So when you add them together, we shall get the total financial requirements. Get the total financial requirements. Get total financial requirements. You get the total financial requirements. Then you less increase in the current liabilities. Increase in the current liabilities. You also less increase in the retained earnings. Also less increase in retained earnings. Increase in the retained earnings. So when you minus now those two items, we get external financial requirements. We get now external financial requirements. Get now the external financial requirements. Let us now get external financial requirements. So I want us to go to the question for November 2016. Question number 3, part A. November 2016. There is a question number 3, part A. So we can go to November 2016. Question number 3, part A. November 2016. Question number 3, part A. So that question for November 2016. Question 3, part A. Question 3, part A. Question reads that, the question reads that management of Georgina Limited, management of Georgina Limited wishes to establish amount of the external financial needs, wishes to establish amount of external financial needs for the year ending 31st December 2016. So the statement of the financial position of the company as at 31st December 2015 was as follows. They gave you plant and machinery, furniture and fittings, motor vehicles, inventory, account receivable, cash and bank, financed by, there is ordinary share capital, retained profits, 14% venture capital, account payables, also accrued expenses. Then additional information, note number 1. Additional information, note number 1. They have said that sales for the year ended 31st December 2015 amounted to shillings 120 million. Note number 2, the company forecast that sales will increase by 10% for the year ending 31st December 2016. Then for the year ended 31st December 2015, after tax profit for the company amounted to 18 millions. Note number 4, the company will adopt 80% payout ratio as it is dividend policy. The payout ratio is expected to remain constant each year in perpetuity. Note number 5, after tax profit margin is also expected to remain constant each year. Assets are expected to vary directly with the sales, while accounts payable and accrued expenses form spontaneous source of financing. Any external financial requirement will be effected through the long-term debt financing. So required amount of external 12% long-term debt finance that will be required for the year ending 31st December 2016. Roman letter 2, they will also like you to calculate forecast statement of the financial position, then finally the weakness of that method. So we follow the 4 steps that I've just given you up there. So the first step, I've stated that we identify balance sheet items which will change when the sales do what? Change. There are 4 of them. The first one will be fixed assets. The second one is current assets. Then current liabilities. Then what? Retained earnings. That one has no problem. You just check in the balance sheet which item will change when the sales change? Those items are 4: fixed assets, current liability, and what? Retained earnings. That's now our step number 1. Then you can see step 2, we express those items as a percentage of sales. So that's now where we start from, because step 1, it is just obvious, you know it. We have simply stated that in the step number 1, we identify all the balance sheet items which will change when the sales change. There are fixed assets, current liability, and retained earnings. So the step number 2 now, we express them as a percentage of sales. We now express those items as a percentage of sales. So we are starting on the step number 2. So step 2, we are expressing those items as a percentage of sales. The first item is plant and machinery, because it is the fixed asset. We start with the one of the plant and machinery. Plant and machinery. Plant and machinery. So plant and machinery, it is 31.2 million. You see that figure? So take 31.2 millions, divide by the sales. So sales, you got the note number 1. Remember, we use the current sales. You can see there are 120. So divide by 120 million, express it as a percentage. So get that figure as a percentage. So if in case it is more than 2 decimal places, just count it off to 2 decimal places. Okay. It's exactly 26%. Yeah, so it's 26. And we got the second item, it is furniture and fittings. Number 2, it is furniture and fittings. Furniture and fittings. Furniture. So furniture and fittings, it is 18.72. 18.72. Divide by 120 millions. Also express it as a percentage. We also express it as a percentage. So to give us what percent? 16%. So this one is 16%. Sorry? Yeah, if it has decimal point, round it off to 2 decimal places. So it will be 16.2. 16.15. So we have it as 15. Exactly 15.6. Yeah. Then we go to number 3. Number 3 is the motor vehicle. Number 3 is the motor vehicle. The motor vehicle. So motor vehicles, it is 12.48. 12.48. Also divide by 120 millions. Then express it as a percentage. 10.4. So 10.4. The next one is inventory. The next one will be inventory. The next one is inventory. So for the inventory, it is 19.2 millions. Also divide by 120 millions. Express it as a percentage. Exactly 16. The next one is account receivable. The next one should be account receivable. Account receivable. So for the account receivable, it is 14.4 million. 14.4 million, also divided by 120. We express it as a percentage. So we should be 20%. Then there is also number 6. Number 6 is supposed to be the cash and bank. Cash and bank. Cash and bank. So cash and bank, it will be 3.6 million. We divide by 120 million. We also express it as a percentage. 3%. So the next one is the current liabilities. The first one there is account payable. So we go to the current liabilities, which is number 7, account payable. Accounts payable. So for the accounts payable, you take 18 million. Also divide by 120 million. Express it as a percentage. Express it as a percentage. So 50%. The last one, we calculate for the accrued expenses. Number 8 should be accrued expenses. So for the accrued expenses, the accrued expenses, it is 12 million divided by 120 million. Also show it as a percentage. This one should be there. So the last one is the retained earnings, but the computation for the retained earnings is different from this other one. So we go to number 9, where we also calculate now increase in the retained earnings. So we go to number 9. We go to number 9. The increase in retained earnings. Go to number 9. So number 9, we get increase in so when you want to get the increase in the retained earnings, we start by first of all getting the projected sales. Under the increase in the retained earnings, you start by calculating the projected sales. Projected sales. So we start by first of all calculating the projected sales. So projected sales, go to the note number 2. Go to the note number 2, where they are saying that the company forecast that sales will increase by what percent? 10%. So if it will increase by 10%, we simply get 110% of 120 million, because currently our sales in the note number 1 is 120 million. So we increase it by 10%. So get 120% of that figure. So we get 132 million. Then we also need to get the net profit margin ratio. The net profit margin ratio. So to calculate the net profit margin ratio, it is supposed to be given by the earnings after tax, or the net profit. The net profit divided by the sales. Then you express it as a percentage. So we need to calculate net profit margin ratio. So to get the net profit margin ratio, it is earnings after tax or the net profit divided by sales. So I want you to go to the note number 3. Note 3, the question had given you after tax profit. How much is that after tax profit? So you take 18 million. These sales, you use the current sales, not the projected sales. Sales, you use the current sales, which is 120. So divide by 120 million. So get that percentage. Get that particular percentage. So we come up with that particular percentage. So what percent do we have at that point?
15.
Sorry? It is 15%. So we get 15%. So after that, we now get the projected net profit. Projected net profit. So to get the projected net profit, simply get the 15% of 132 million. We simply get 15% of the projected sales. Simply get 15% of the projected sales. So what will be 15% of the projected sales? 19.8 million. So once we get that, now we can get increase in retained earnings. Increase in retained earnings. So to get increase in retained earnings, simply take the 15%, not 15%. Sorry. Dividend payout ratio, they gave us what percent? Dividend payout ratio. Are you able to see dividend payout ratio in the note number 4? Is 80%. So if we pay out 80%, we retain which percentage? Yeah, so increase in the retained earnings now get 20% of 19.8 million. Because out of the 19.8, we pay dividend as 80%. So now the retained earnings will be 20%. The retained earnings will now be 20%. Now be 20%. Then after that, also now get the increase in the sales. Also calculate increase in sales. So to get the increase in sales, you take 132 million minus 120 million. Get the increase in sales. You take 132 minus 120 million. So now from there, let us now answer. Those who are just the workings, we now answer the Roman letter 1, external financial requirements. So those workings are enough to answer the entire question. So we start Roman letter 1. So we want to get the external financial requirements. We want now to get the external financial requirements. External financial requirements. External financial requirements. So to get the external financial requirements, we start with the increase in fixed assets. So we start with the increase in plant and machinery. We start off with increase in plant and machinery. Increase in plant and machinery. So that increase in the plant and the machinery, we got to which percent? Plant and the machinery, we got to which percent? So you take 26% multiplied by increase in the sales, the one that we have just calculated. That increase in the sales was how much? It was 12 millions. Yeah, so get 26% of 12 millions. So that will now be the increase in the plant and the machinery. We also factor in increase in furniture and the fittings. Furniture and fittings. Increase in the furniture and the fittings. So furniture and the fittings, we go to which percent?
15%.
Take 15.6%. 6%. Also multiplied by 12 millions. Also multiplied by 12 millions. The next one will be increase in the motor vehicles. Also add increase in motor vehicles. So increase in the motor vehicles, we got which percent? 4%. Also 12 millions. Also 12 millions. The next one, the increase in the inventory. Increase in the inventory. So for the inventory, it's what percent? So 16% of 12 millions. 16% of 12 millions. Then also the next one will be increase in account receivable. The account receivable. So increase in the account receivable, what was the percentage?
12%.
So get 12% of the 12 millions. Get the 12% of the 12 millions. Then the last one there is cash and bank. Increase in cash and bank. So this one was which percent?
3%.
3% of 12 millions. So you will add those figures together to get the total financial requirements so that you come up with the total financial requirements. So that you get the total financial requirements, which is giving us which value. So add them together. This is 9.96. Then now we less increase in the current liabilities. Now let's increase in the current liabilities. The first current liability is account payable. So account payable, increase in account payable. Account payable, you got which percent?
2.
So get 15% of also 12 millions. Get 15% of also 12 millions, which is supposed to be
1.6.
then also less increase in accrued expenses. So accrued expenses, you got which percent?
10%.
So it will be 10% of 12 million. Then, nakumbuka retained earnings, you also less increase in retained earnings. But this is what you calculated. You calculated something about the retained earnings. How much was that? 3.9. So that one we have already calculated. So subtract those three items now to get external financial requirements. Get the external financial requirements. So that you get now external financial requirements. So that we come up with external financial requirements. So that you get now the external financial requirements. So imewapea which figure? 3 million. So that is your Roman letter 1. So that Roman letter 1, it also assists you to get the Roman letter 2. Roman letter 2 is a forecast statement of the financial position. Let us now prepare the forecast statement of the financial position. The forecast statement of the financial position. So we come up with the forecast statement of the financial position. Forecast statement of financial position. So we prepare now the forecast statement of the financial position. So that forecast statement of the financial position, you repeat the statement the way it is. You arrange it exactly the way it is. The figures the same plus the increases. The figures the same plus the increases. So we start off with plant and machinery. We start off with the plant and machinery. Plant and machinery. So plant and machinery, we are given that 1.2 million. The minimum calculated quarter increase. 3 point. So you add 3.12 million. Get that figure. Then you go to the second one, furniture and fittings. Furniture and fittings. So furniture and fittings, you have 18.7. We also add that increase. Your increase in which figure? 1.872. We go to the next one as motor vehicles. We go to the next one as motor vehicles. So for the motor vehicles, it is 12.48. 12.48 million. Then we add, what was the increase? 1.248. The next one is inventory. The next one is inventory. So for the inventory, it is 19.2 million. plus how much was the increase? 149. The next one is meant to be account receivable. Account receivables. So for the account receivables, it is 14.4 million. Tuna add in that thing.
1.4.
1.4. Get the value for that. The next one is cash and bank. Cash and bank. So cash and bank, we have 3.6. We add the increase. Increase is which we are 3.6.
360,000.
So 0.36. So add them together. You add them together. Add them together to get the total value. You add them together to get the total value. Add them together to get the total value. Tunapata ngapi? Sorry? 109.56. Then now you go to finance by. You see the format of the statement. You follow exactly the format of the statement. So we go to finance by. Financed by. Go to the first. So under the financed by, we start the ordinary share capital. Start with the ordinary share capital. So ordinary share capital will never change. That one will remain. You just write the way it is. It is 42. Ordinary share capital will not change. Retained profits. Retained profits. You simply take what we have, it is 17.6. We calculated the increase. Remember, increase in the retained earnings. We got which figure that calculated it. 3.96. 3.96. So that one we had already calculated. Then 14% debenture. Also, that one is a long term debt. 14% debenture. This one would not change. The 14% debenture is a long term debt. It is just going to be 10 million. It's going to be 10 million. The next item is account payables. Account payables. So for the account payables, you take 18 million plus the increase. 18 million. So increase was how much? Then the next one is accrued expenses. Accrued expenses. the accrued expenses, it is 12 million plus. Hiyo tulipata ngapi increase? One. Then after that, tuna include hapo chini external financial requirement. So you include here external financial requirements. So we include their external financial requirements. Your figure tunapata hapo is what 3 million. Yeah. So now nataka mu add the totals. So after that, you include down their external financial requirements, which we calculated in Roman letter 1. So it should balance by itself. So confirm whether it is balancing, because it is supposed to balance by itself. It should be able to balance by itself. It should be able to balance by itself. Is it balancing? Yeah, so that's now our Roman letter 2. That should be your Roman letter 2 statement. So now I want to give you the assumptions or weaknesses of the percentage of sales method. That's Roman letter 3. Roman letter 3, they wanted you to give them the weaknesses or assumptions. So weaknesses are the same as the assumptions or limitations. Weaknesses are the same as the assumptions or the limitations. Weaknesses are the same as the assumptions or the limitations. Number one is that, number one would be that the company is operating at full capacity. The company is operating at full capacity. The company is operating at full capacity. Therefore, increase in the sales, will lead to increase in the fixed assets. The company is operating at full capacity. Therefore, increase in the sales will lead to increase in the fixed assets. It will lead to the increase in the fixed assets. The number 2 is that it ignores inflation in the economy. It ignores inflation in the economy. Number 3, we also write that it ignores the concept of the time value of money. It ignores the concept of the time value of money. It ignores the concept of the time value of money. Then the next one is that the corporate tax rate will remain constant. The corporate tax rate will remain constant during the period under analysis. The corporate tax rate will remain constant during the period under analysis. Then the last one is that during the period under analysis. Then the last one would be that the relationship between balance sheet item and the sales. The relationship between balance sheet items and the sales. Relationship between the balance items and the sales will remain constant. Will remain constant during the period under analysis. It will remain constant during the period under analysis. It will remain constant during the period under analysis. So, mtafanya a question as your assignment, November 2011. November 2011, question 4A. November 2011, question 4 part A. So, mwende msome hiyo, mtakuwa available on Friday, jioni. Online, I can also meet you on Friday in the, like size. Is it okay? so that we do something brief on the cash budget and also another small item. So can we agree on that? Those who are online. Online, we can meet on Friday also the same time that we have met today. Yeah, just be available. We do some of those small things. It may make some changes. So we meet on Friday, just the normal time, the way we have met today. So we can stop there for now.